Welcome back. Well, the markets are under pressure, but what is evident is there is some buying at lower levels. You know, we were down, we went down all the way to around 16,930 odd. But from there, there's some sense of buying that's coming in there. The first hour low will be something that you should be tracking, and then we'll have to see whether or not we can defend that to see some bit of a sustainable pullback. Well, we just heard out the management of Berger Paints, but let's focus on the markets then. Harold van der Linde, head of equity, Asia Equity Strategy at HSBC, joins us for some market talk. Hi, Harold. Good morning. Thanks so much for joining in. Well, from the last time we spoke, plenty has changed. I recall you telling us that, in fact, being underweight Asia is not such a great idea. But the equity markets globally have gone into a bit of a tizzy. How do you approach global equities right now? And still, do you believe that emerging markets like India and China could do relatively better?
Yeah, I still think they can do relatively better. But let me tell you how we approach emerging markets. So, the beginning of the year, we thought that we would see some sense of peaking in inflation in the developed economies. Those signs are there, and markets have responded positively to that. But then the downward trend has been slower than what initially was anticipated. And what we now, of course, see is that the increase in interest rates in the US in particular is starting to have a lot of stress on the banking system. You guys have talked about it a lot, what is happening in Europe, what's happening in the US, and that is creating all sorts of risk aversion as well. But if I look at the Asian equity universe, I think the earnings look solid. Look at India, for example. The earnings look solid, come probably in at around 20% this year. The banking system is resilient. You've reduced NPLs over there. So I think Asia should be able to weather this quite well. So I think we'll end up the year higher than where we are right now.
Harold, good morning. This is Sonia here. So, the problem really is not what's happening with the banks, but what's happening with Credit Suisse and the 81 bond holders, right? I mean, it looks like their holdings are going to be sort of wiped to zero. At least that's the concern. And then the ramifications that would have on other asset classes. How would you read into it? And what do you think the way forward would be, both for global banks as well as perhaps banks in emerging markets, including India? Do you see more pressure?
Yeah, no, this is clearly a near-term risk. This will not go away. I mean, it's difficult for me to look at the in those particular bonds in particular. But I used to be around in Indonesia in the late 90s when a similar process was unfolding. And yeah, equity shareholders and bondholders get wiped out if companies go down, or in this case are being taken over. So that means there will be pain in the system. But again, you have to take away from what is happening at the moment and the stress that some of the asset managers or banks might face because of exactly what you just mentioned. Their holdings are being wiped out. And what the fundamental story in Asia is. And that is a story of recovery. That is a story of benefiting from global trends. Bond yields starting to come down. That is a story of robust growth, in particular, I would say, actually, in India. So the underlying story looks okay. So the question really is, should you be selling or buying in a downward market here? And I think it's buying in this case. The fundamentals look okay across the region. I'm not overly worried about that. So I think that would create opportunities.
Harold, good morning. Surabhi here. And what you're saying sounds so good, right? Because the proof of the pudding is in the eating, and India's demonstrated that. The banking system here, not once but twice now. So, okay, let me dig a little deeper on that point. What would you buy in India? Where are you comfortable with the valuations? Are you looking for, let's say, growth in consumer, or are you looking at the capex part of the market over here?
Yeah, I think the attractiveness of India lies in the fact that some of the companies are incredibly profitable and that they have businesses which are incredibly difficult to replicate. So competition will not come in quite easy. And those are companies with wide, large distribution channels across Asia, across India. So I would be focusing on that. So you end up with consumers, you end up with banks and these sort of things. I understand that the CAPEX story is pretty good in India for the moment. So some CAPEX plays, yeah, that's really nice. I would probably shy away from, say, IT and pharma, because that's more exposed to some of the global trends. But what I think what makes India a unique equity market is is those domestic distribution channels. And we've seen so often that, say, foreign companies or local startups try to get in and really struggle to take on those incumbents. So those are always the companies that I would look for first.
Harold, okay, hear you very carefully. Just a follow-up question that, while investors look at some of these bets and evaluate whether they want to put money here, China was always the choice. At the start of the year, that's what the trade was. Sell India, go buy China. We were speaking to certain participants, market participants from one of your peer banks, US banks, and they believe that that trade is in its final leg. It's nearing its end. What do you say?
I would probably agree with that to some extent. I mean, we like China as well. And China has its own sort of story, but I think that is really a 2000 and kind of a current year story, and maybe that goes into next year. I think India is a longer term story. I feel more confident with the earnings growth on a kind of a 3-year basis in India than I would do in China. But also we've seen a massive relative performance. Whereby, as you mentioned, India has been sold in order to fund purchases in China. Chinese holdings have gone up, India holdings gone down. The market in China has gone up, India has gone down. So India at the beginning of the year looked pricey against China, but now that situation has changed. So on a relative basis, I think India is starting to look better.
Oh, that's pretty good news then, Harold. India, the three-year story looks better. Harold, from the domestic themes that you're looking at in the Indian markets, what's your preference out there? You told us you wouldn't go with IT, you wouldn't go with pharma here in the Indian markets. But what would you buy then here from Indian equities?
I think I would look at a couple of things. It would be channels into kind of rural, semi-rural areas. That's a long-term kind of theme I would be looking at. Other themes I will be looking at is EV supply chain. That's maybe a bit of a capex story there, but that's something to look at. And then, yeah, simply consumer companies that, as I mentioned, that can just distribute so extremely well. That is just to stress the uniqueness of that. There are no companies in Asia that come even close to the profitability that some of these companies have. Now, typically, they also trade at high valuations, but because India has come off, yeah, those valuations are maybe still relatively high, but not as expensive anymore. And on a relative basis, look rather attractive at the moment. So you're talking about car companies, right? You're talking about food and beverage names. You're talking about jewelry or other sort of retailers that have a wide distribution across the nation.
It's interesting that you say, you just said that you would shy away from IT stocks. I mean, you were one of the biggest IT bulls, especially in the Indian markets. What has changed your thesis? I mean, is it the resignations that you've seen recently from some of the top companies like Infosys and TCS, or is it the exposure that the IT companies have to regional banks in the US?
No, there's two stories going on. It is that exposure, but in the beginning of the year, late last year, we all thought that the US and Europe would be in a real pickle at this particular point in time. And in particular, Europe, high gas prices, the economy would be very weak. Turns out that things have been much better than was anticipated. And that has led to a rally in globally exposed stocks across the region. Korea and Taiwan are some of the best performing markets for that reason since the beginning of the year. So that has now been repriced, but still the outlook is going to be one of weakness later this year. So I think, generally speaking, I would at the moment prefer more domestic-oriented stocks than export-oriented ones.
So when you talk about domestic-oriented stocks, right, you spoke about the capex theme and a couple of more domestic consumption spaces. Anything else that you like? How about autos? Because there is a bit of a pickup that we're seeing there, especially in some domestic pockets, whether it's SUVs, passenger vehicles, tractors a bit as well. Has that been on your radar recently?
That has been on our radar as well. And we've looked at a couple of these auto stocks in the last couple of days. So that's absolutely right. We like that as well for exactly the same reasons that I mentioned. So I should have mentioned auto as well, but it fits very much into that story of domestic distribution channels. Yeah, and as you mentioned, we've seen a pickup sometimes in parts of the rural economy in two-wheeler and sometimes four-wheeler sales, right? So that's good.
Harold, pleasure speaking with you. You have been, a voice of optimism in this rather confusing world. Thanks for joining us, and you have a good day.
You too.
All right, the market for the timing is holding its losses. The good news is that at least we're not seeing a further slide, so it's still 150 down and kind of holding over there. Holding is the best case scenario, at least for now. Let's take this to the next conversation then, and we're focusing on a company now. Thermax is on our radar. Earlier in the month, the company entered into the green hydrogen market in partnership with Fortescue Future Industries. Together, the two will develop fully integrated projects for commercial and industrial customers in India. Ashish Bhandari, MD and CEO at Thermax, is with us. Ashish, good morning. Good to have you on the show. So first things first, tell us a little more about this partnership. What part of the green hydrogen chain are you going to be in? How much are you spending? What's the revenue potential? Lots of questions. So tell us all about your green hydrogen plans.
Very good morning to you and to your viewers. And looks like we're jumping straight into it, which is good. Let me first start with the first part of your questions, because that's where I can spend a bit more time. The second and third, I'll politely decline to answer at this point. The idea of partnering with FFI and Fortescue specifically is to energize the hydrogen sector in India and whichever markets we together want to operate in. Simply put, FFI and Fortescue has possibly one of the world's biggest mandates from their board and their charismatic leadership to make hydrogen happen and to get the world closer towards net zero. For India specifically, there is an ambitious plan also that has been chalked out by the government. I've shared previously some of the policy decisions that are expected. We are still in the infancy of some of the work that is needed, but it is important to get started early, which is why this is an MOU. And the MOU focuses on three broad aspects of partnership. The first one of which is around developing hydrogen-based projects for the industrial sector. And this is steel, beyond that into fertilizers, refineries, a lot of projects that are of an industrial application use. Second is the ability to do EPC, not just for projects in India, but globally as well. And third, should demand take off in India and there is a need for local manufacturing of electrolyzers, this is also something that this partnership will actively look at. So these are the broad aspects. We have come in with the idea that the market needs to happen, and the partnership will look to make the market happen. Yeah, what is the scale and scope that is possible? How big can it be? What is the level of investments? It's too early. While we have some projections, it's too early to share any of that, because as I said, there are a lot of external factors that determine the scope and size of what we choose to do together.
Got it. All right. It's too early to give us details on that. By the way, just wanted to get our eye back on the market, which is selling off quite rapidly. The Nifty now down 160 points. And it's not just the global facing stocks. You know, a lot of domestic facing stocks are under pressure. M&M has been one of the biggest losers this month. It's down about 10% this month and exerting more pressure this morning. Bajaj Finance, IndusInd Bank are also your top losers. So just keep that on your radar. Not looking good in terms of a market screen. Ashish, hi, good morning. So since you can't tell us too much about this opportunity at the moment, tell us a little bit about the business, right? The last time we spoke with you, you had indicated that there is a bit of a slowdown that you're seeing in terms of ordering activity, especially in domestic refining, petrochemicals and FGDs. Has that slowdown abated? And what is the kind of growth that you're penciling in FY24?
So the first part, I had said there was a slowdown in large projects. And large projects, especially of the kinds that you talk about, have been cyclical for as long as we have known them. Yep, India had at one point multiple refinery projects going on. Those are all at the end of the ordering cycle, and a new one will start at the right time. I have continued to be bullish that, and the Thermax story is a reflection of a larger industry story. And the fact that demand across sectors, which is beyond these large rupee value orders that the market looks at, continues to be stable and good. gives me confidence that there is underlying strength in the marketplace, and I'll continue to hold on to that line because I'm not seeing anything different at this current moment. Yeah, we've got no big orders, but enough visibility to indicate that the momentum for new energy solutions, the momentum for broad-based and the capex story is not a general capex story. Thermax's story is the need for water, the need for cleaner energy, more efficient energy, and so these themes I expect are continuing at a medium and small scale as well, and that continues to give us strength across this. And I don't see any. And which we know, large orders, we have got visibility good 6 to 12 months before they show up. And we don't see large orders for the next 1 to 2 quarters to share. Yeah, that part continues to hold.
All right, Mr. Bhandari, we're a little short on time, but input costs have cooled off. And if, operating leverage is going to play out by way of execution of some orders, revenue growth is going to be there. What is the margin band you're looking at from here on? You're still in those high single digits, close to around 7 to around 8% odd. Do you believe it can improve further from here?
You've seen that in the last year and a half, as our top line has improved, that effect on the bottom line is also was actually improving. The reason it did not show was we went through this good 9-month cycle where commodity prices were just going up much faster than we could increase prices. That has cooled down. That should reflect a little bit in our margin improvement, but not a whole lot. I don't think we will reach double digits anytime soon, just because this is also a period where we think we need to take some of what we are earning and invest back, because just like the example that we shared about green hydrogen, bio-CNG, load of renewable-based opportunities, load of carbon capture, there are a lot of new technology areas where we need to get moving on. So this is also a period where we will be investing. We won't be taking everything that we get back in terms of operating leverage and putting it down to a bottom line. This is a period where we will be looking to invest in small ways and in big ways.
Got that. Good speaking with you this morning, Ashish. Thanks for stopping by and giving us some perspective on the business. That is Thermax. The market has turned for the worse. Guest spoke too soon. Pull up the intraday because we're now looking at a near 200-point drop on the Nifty. So it's getting a little uglier. There's additional selling. Pull up the intraday of Apollo Hospitals, for instance. So some of the stocks are selling off big time now. The Bajaj twins, Finserv and Finance have seen additional pressure. And auto stocks are seeing, that's the big Apollo Hospitals decline. And auto stocks are seeing a lot of selling today. Eicher, you have a couple of other names as well. Tata Motors on the downside. Britannia, at some point in the middle of last week, there was this move to FMCG. It was only one day last week. This morning, even that is not visible. We are seeing plenty of red. The only FMCG stock in positive is actually Lever. The classic trade of rush to FMCG in times of uncertainty, not happening in 2023, at least not, not clearly visible in the environment right now. Let's go back to Mitesh for some ideas. Mitesh, I remember, I think you were saying that you were looking to, you're looking at buying a dip and then try and sort of trade it on the upside. Are you still holding that that thesis? What would you be doing now on the index?
Morning again. See, my idea is that the index might consolidate between 16,800 to about 17,150, and therefore buying closer to about 16,825 is what I will explore. So another 75, 80 points lower from here. Good chance that we will see 16,800, that support area come into play again, and we can get one more bounce back. So I think that's the kind of view we are taking, and we'll take about a 55 point kind of a stop loss from levels of around 16,825. Having said that, I have right now one buy and one sell call. The oil refining stocks, the refinery stocks are doing well, and I've got a buy on IOC. Keep a stop at about 79 or just below it over here and look for target of around 85. While you were highlighting auto names, we had a sell on Eicher earlier. Now I have a sell on Ashok Leyland, which is a sell with a stop at 139 for targets of 130.
Okay, so a lot of auto stocks, a sell call coming in over there. By the way, Reliance is at a fresh 52-week low as we speak. So 21.93 on Reliance. The stock is now down almost 15% this year. So a big underperformance compared to the market and, big slide in trade this morning as well. Fresh 52-week low on Reliance Industries. In fact, talking about 52-week lows, many stocks in the sugar space, some of the pharmaceutical names, Laurus Labs, etc., are sitting at fresh 52-week lows. Emphasis is at a fresh 52-week low as well. So not looking good for the market on the whole. Let's slip into a quick break. On the other side of the break, Manisha Gupta will be here to put focus on how the commodity markets have been shaping up. Stay tuned. Well, as I was telling you before the break, not looking good at all. In fact, almost a 600-point slide on the Sensex now. But Manisha Gupta is here to tell us about whether the situation is any different in the commodities market. Manisha, what are you tracking today?
Well, I'm looking at all things gold, and it's trading at an all-time highs right now. Because of the concerns everywhere else, the safe haven or the flight to safety clearly seems to be coming in case of gold. So the earlier all-time high was 59,350. We're trading at 59,400 plus kind of levels. This is an all-time high for the gold prices in the Indian markets. And not just India, Australia also has hit an all-time high in sense of gold prices there at around 2,922. For the international markets at 1975, we are trading at a 11-month high in the dollar terms for the gold prices, but good going, and we have seen prices gain up by 5.5% in the previous week, which has been the best gain in a weekly sense in last 4.5 months, or the best gain really when you have seen in last many months there. The gold prices have seen gains constantly in all of these months and this year right now. The emergency liquidity measures from the US Fed and other central banks is something that clearly seems to be supporting the markets. With this now, the kind of liquidity that has come into the international markets is expected to stand at $2 trillion. I mean, just as the Fed was binding its beige book, purchase book, etc., we have seen more money printing and more money coming into the international markets, and that clearly seems to be supporting the gold prices there. The weak US dollar, the recent financial turmoil, all of that has been supportive. You also are looking at the US Fed meeting, where the expectation is that there's now 80% of a probability of a 25 basis rate hike. Also, the major central banks could be softening their stance on the inflation. That has been supportive for gold. And it's not just the US Fed meeting which is happening in this week. You also have the Bank of England, SNB and Norges Bank also talking about their monetary policies in this week. You also have inflation data coming in from Japan, UK and Canada. And then you have the PMI numbers also coming in from various countries like US, Japan, UK, Eurozone, Germany, France and all. What you are looking at is a big range right now in sense of gold prices. Last year, we saw a range between 2,052 to 1,789. We have seen 1,810 of a low in this year already. And from those kind of levels, nearly $200 of a jump up is what the gold prices have done. If you look at the report card till time, for the month of January, we saw good gains come in for gold. Feb wasn't so great, 7% of a decline. And for the month of March, we're already up by 7% and at all-time highs in Indian markets.
Okay, all right, Manisha, thank you so much. So many central bank meetings, so much happening. This is going to be a busy week. Thank you for all of the details over there. Well, with that, let's turn our eye on some of the Adani Group stocks. Actually, Adani Enterprises, to be quite specific. Vivek is back with us. Vivek, so tell us some more details, because the market's definitely taking cognizance of this. The company pulling back on its specific capex plans with respect to this project.
Well, absolutely right. Actually what's happened is over the weekend, PTI has reported that the company has suspended work and has written to its various vendors regarding stoppage of work as far as a petrochemical project in Mundra, Gujarat is concerned. Now, the planned capex for this particular project was close to 34,900 crore. And along with that, the company has also suspended plans to raise 14,000 crore as per the report. Now, interestingly, this particular subsidiary called Mundra Petrochemical was set up to go ahead and set up a significantly large greenfield coal to PVC plant in Gujarat. So we reached out to Adani Enterprises. What they said is that they are now evaluating the status of growth projects in the primary industrial verticals over the coming months. So it does look like, there has been a scale back as far as capex is concerned, and markets at this point of time not really liking that.
Okay, thanks a lot for that. So that's on Adani Enterprises, a scale back of their projects and something that they've, done in the past couple of weeks. But Vivek, the other stock that you're looking at this morning is Cochin Shipyard. Why is that?
That's right. So Cochin Shipyard, some positive news flow coming in here. The company has got an order for 2 container vessels, and this is from a Netherlands-based company. Now, the total project cost is 550 crore, and in a slightly more positive development, this particular order actually has a clause where the company can go ahead and sell or provide 2 more vessels. Interestingly, the management commentary in the press release is quite encouraging. They're saying that while these ships are intended to serve the European market, the sustainable transportation solutions are in high demand in Europe, and which is what makes them more positive on this particular segment itself.
All right, thanks a lot for that. So that's on Cochin Shipyard, a big move coming in 6% higher now. We'll slip into a quick break. On the other side, our special segment, It's the Economy. Lata will get chatting with Neeraj Gambhir of Axis Bank and Srinivasan Vardarajan of Union Bank of India after UBS agrees to take over crisis-hit rival Credit Suisse for $3.2 billion in a historic deal. Stay tuned for more.